In 1983's WarGames, a supercomputer runs every possible nuclear war scenario and lands on the same conclusion. A strange game. The only winning move is not to play. Wall Street had a bit of a WarGames week of its own, a lot of players trying to outguess a market that mostly punished anyone who tried. I'm Jose Martin with LifeCraft Wealth Management, and this is your Monday Market Minute. Big tech earnings season hit a nerve. On Thursday alone, the largest tech companies lost nearly $800 billion in combined value in a single session, as investors got nervous about just how much money is being poured into AI. The S&P 500 finished the week down a bit over 0.5%, its second losing week in a row, and the Nasdaq fell harder, down about 2%, and the market's fear gauge jumped to its highest level in weeks. Well, that wasn't the only thing moving markets. Fighting in the Middle East pushed oil prices sharply higher again, briefly touching $100 a barrel before easing back toward the end of the week. And the White House rolled out a new round of tariffs, though energy products got an exemption. But zoom past the headlines, and the economic data underneath was actually encouraging. Weekly unemployment claims fell to a 5-week low, and a widely watched survey showed U.S. business activity growing at its fastest pace in 8 months. The stock market had a rough week. The economy underneath didn't necessarily agree. And one more thing worth knowing. A closely watched Wall Street sentiment gauge just hit its most bullish reading since 2021. Now, historically, when investor optimism gets that stretched, it's often preceded a pullback. Not a guarantee, just a pattern worth being aware of. It's less a reason to react and more a reason to know where you actually stand. Markets that whipsaw on a single earnings call or a single headline are, almost by definition, markets where the loudest move is usually the wrong one. Sometimes the only winning move really is just staying in your seat. I'm Jose Martin, and I'll see you soon.